Right, I am going live now. Good afternoon, everyone. Let's kick this off. Today, we are talking about mitigating risk in digital assets markets, and we have some remarkable and compelling leaders of our industry to discuss all sorts of risks and how we can make sure that that we mitigate these and we raise a relevant amount of attention. At the CVA, we really value insightful and informative educational sessions like these. A shout out to Oliver for initiating this panel around risk. Thank you so much. And maybe a quick intro from my side. Emmy Lurins, president of the Crypto Valley Association. And in my full-time role, I proudly work for Talos. In this capacity, I will be focusing on or wearing my CVA hat, as we have Anton, the CEO of Talos, and we have Nicola, the CEO of B2C2. We have Rob from Dragonfly Capital, as well as Olivier from Upload. Please be so kind and introduce yourself. Let's start with Nicola and to share a few sentences about your company you represent today.
Yeah, thanks, Emmy, and thanks for organizing this, and Oliver for suggesting it. I think it's very timely, and we're going through a lot of change recently. So we were joking earlier that we probably have more topics to talk about than we can fit into an hour, but we'll try to cover as many as we can. Nicola White, I'm the CEO of B2C2. B2C2 is a large institutional liquidity provider. So we only face institutions. And when you trade with us, we actually take the other side of the trade. So we're creating liquidity. And one of the reasons why I think that's important, is that if the market's one directional or, there's a one-sided flow in a coin, you really want to have someone who will take the other side of the trade for you. But with taking the other side of the trade and putting our capital to work comes a lot of risks, right? We'll talk about counterparty risk. We'll talk about concentration risk. And so really excited to dive into all of those topics and how we think about mitigating risk, not only for ourselves, but also for our clients as they're looking to execute large block trades.
Thanks so much. Anton, you want to go next?
Sure, and thank you very, very much for having me and for having this panel. I think, very, very timely discussion, and risks are on everybody's mind. So I'm really looking forward to this discussion here. Talos is a one-stop shop for institutions that are looking to get access to digital assets. So generally speaking, when we started the company, we used to say that Talos is a trading platform, and we've grown past that. At this point, what we do is we provided technology. So unlike Nicola, we are not a counterparty to the trade. We are a technology provider that allows our clients, and those are institutions across the world at this point, to connect with the underlying providers like custodians or liquidity providers like B2C2, but also exchanges or clearing and settlement facilities to really execute the trade and manage that entire trade life cycle. So we allow them to put the pieces together, and then we provide services on top of them, like algorithmic execution, portfolio management, and so on and so forth. That's kind of like how we partner with the underlying institutions, underlying providers, to provide institutions with the ability to execute their investment strategies in crypto.
Thanks so much. On to Olivier and Upload.
Yeah, thanks for having me, and I'm delighted to have the opportunity to speak with everybody here. So Oliver Yates, I'm the CEO of Applo. We're a EU licensed prime broker for cryptocurrency. So our offering relies on several pillars. We provide market access solutions, trading on exchanges, trading with OTC counterparts, some execution services as well. Provide some strong financing solutions as well. We'll have custody, of course. We're regulated custodian in France, and finally some technology services around reporting and governance and data services. And obviously, risk has been top of mind for all of our customers since the downfall of some very big exchanges. And as a prime broker, they come to us to find some solutions on lowering that risk for them.
Thanks, Olivier. We have remarkable VC with us, Rob, representing Dragonfly. Rob, on to you.
Thanks for having me, Emmy. As Emmy said, I'm one of the general partners at Dragonfly. We're a crypto native investment firm. We've been investing across the crypto ecosystem in pretty much every vertical since 2017. We're primarily known as a venture capitalist. We do also have a vehicle for some long only crypto token trading as well. And I lead pretty much all of our kind of mid-stage investment efforts, as well as stuff we do across certain verticals, specifically around, say, CeFi and some of our DeFi stuff in North America and Europe.
Thank you so much. I want to encourage the audience to ask questions. I prepared quite a few, but it's nice if you guys want to engage as well. No exchange. However, the first question goes to Nicola and Anton. Basically, to bring listeners to a good understanding, can you share a bit typically who are your clients and what type of risks you help them mitigate?
Anton, do you want to go first?
Yeah, I'm more than happy to. So generally speaking, Talos tailors our services to two types of customers, really covering the entire gamut of the institutional customers. We have buy-side institutions, so your hedge funds, your proprietary trading desks, anybody that's trading crypto using their own capital or the capital of their customers. Those kind of clients come to Talos to really manage the entire trade life cycle. So, we have portfolio management services, and we achieve that through connectivity to multiple custodians. We're not a custodian ourselves. And that allows our customers to do treasury management or actually take a look at the risk on a portfolio level. We have trading services, and we have algorithmic trading, multi-deal RFQ, and the likes. And we do that by connecting to close to 40 to 50 different exchanges, OTC desks, dealers, market makers. We have clearing and settlement services. So we partner with the likes of Fireblocks and Coinbase and Copper to be able to facilitate the settlement and the clearing post trade. And that's kind of like our buy side customers. On the other hand, we have the sell side customers, which now is effectively half of our business. Those customers are the ones that are offering their clients with the ability to trade crypto using our technology. So we white label our technology either on a multi-deal or a single dealer basis. So if you're looking to stand up a brokerage and you're looking to really have the entire interaction with the clients, we have the full suite of tools for you there as well. And with the recent acquisition of D3X system that we announced about 2 weeks ago, we're adding to that mix the ability to do more pre-trade portfolio engineering. So we now support things like portfolio rebalancing and portfolio optimization, risk attribution systems, backtesting. And that's really some of the tools that are used by some of the largest institutions in traditional markets that are looking to really manage portfolios on their own behalf or on behalf of their customers. So, we throughout this panel, we'll talk quite a lot about risk, but for us, a lot of times it's making sure that the clients really have the ability to architect the investment life cycle that they want, right? It's the client can come and tell us, hey, we want to use these 2 or 3 custodians because they need to use multiple custodians. We want to use these 5 or 6 liquidity providers. We want to settle our trade this way. And at the same time, we want to have tools like reconciliation, which reduces quite a lot of risk, of course. They want to have transparency and reporting, and those are capabilities that we offer to our customers. So really think of us as, tailoring to the institutional landscape of clients, providing them with the same kind of tools that they're used to having in capital markets, the same kind of level of safety, level of transparency, and definitely operational risk.
Yeah, and I would just echo some of Anton's comments. So, I think from a client's perspective, we have a lot of overlap. Our clients are the largest institutions, both from the crypto native side and also the traditional finance side. Many of our clients use Talos to connect through to us. And when we're talking to clients about risk, I was looking at all of the different topics that we typically cover when we do an onboarding call with a client, and it can be, somewhere between 15 and 20 different topics we'll dive into just on risk alone. And they kind of range anywhere from credit, right? So when a client faces us, they have credit exposure to us, we have credit exposure to them. Well, they should be concerned about how we think about extending credit. So, if you're a high quality client, how are your liquidity providers thinking about extending credit to other clients? Because you inherently have a portion of that exposure, right? And then market risk, right? So that's where places like Talos comes in, right? So if you have a large block trade to execute, are you showing it to 15 client dealers, and then all of a sudden, there's that information leakage, or are you going to show it to one person and they're going to TWAP it or VWAP it for you over the course of a period of time? And so I think the one thing I would say is, it's not as straightforward as, and I think, Anton, you mentioned diversification. It's not as straightforward as just getting one counterpart, which we saw last year. A lot of people had given all of their exposure to one counterpart. Well, if that counterpart goes down, then you're in some serious trouble, right? There's so many people that said, oh, well, I was sitting on a large treasury portfolio of Bitcoin and that's gone down 30%. What can I do? Well, at that point in time, there's not much that you can do. Just like if you've loaned that Bitcoin out to someone and all of a sudden they're in bankruptcy, well, if you would spread it across 3 or 4 people, you at least can sustain that type of an event. And so we talk to clients a lot about diversification, having backups, and then making sure that, there's multiple layers of redundancy in place. Because one risk I think that the crypto native side is really familiar with is the actual risk of transferring crypto, right? In traditional finance, if you were to transfer something to a bank and you transfer it to the wrong location, you can pull it back. In crypto, that's impossible, if not a lot harder to do. And so, for traditional finance people getting into it, we talk a lot about crypto specific risks, right? How do you use technology to make sure that you have multiple signatories and you can't just transfer money out or crypto out in one foul swoop? And so I think the risks that we talk about vary versus if you're a crypto native person and we're talking about, bringing some of the traditional finance practices into play versus if you're a traditional finance person and we're talking about, some of the crypto native specific risks.
Thanks, Nicola. Thanks, Anton. I'm hearing here technological risk, counterparty risk, operational risk. Let's look at the VC's perspective, what types of risk you encounter, Rob, and then how you see mitigating these risks.
Yeah, thanks, Emmy. I think from a VC perspective, obviously it's a little bit different than what Anton and Nicola are talking about here. And we're exposed to risk in a number of different ways. And we often get questions from, our LPs and, people within our network, et cetera, like how do we manage our operational risk? And, we think about things, it might be idiosyncratic specifically to being and inherent to being a crypto investor. So things like custody, like we're talking about, or even as simple as like cybersecurity risk or, key man risk, et cetera, at the firm. And we're constantly working with, best-in-class technology providers, with advisors, et cetera, to stay on top of that. But I think we're also even more focused on, what is the risk within the portfolio, right? And so we often have our portfolio companies come to us and say, hey, listen, we have this issue, we have this problem, we're thinking about this type of risk. Can you help us mitigate that? And we spend a lot of our time thinking about what that looks like. And so that might be anything from a DeFi protocol to a layer 1, layer 2, to CeFi business, wallet, et cetera. And one of the things that's actually been the most topical over the recent months has been things like banking risk, right? Which is not even inherent to being crypto, but what we've seen with Signature and Silvergate and SVB is people are starting to think more thoughtfully around what is the appropriate treasury management strategy? How do we sign up for or get exposure to more banking counterparts? Is being in a US bank even the right thing for us? Should we be more on chain? Should it be USDC? Should we be in treasuries through something like a BNY Mellon? et cetera. And so we work a lot with the portfolio on, how do we navigate those issues? Do we do things? And what we tell people is, listen, you need to have a number of banking partners, 1, 2 banking partners. That's not the right amount of banking partners. You need to be more thoughtful around what the treasury management practices look like, how much, cash, and what is that difference between cash versus crypto versus stables, et cetera, looks like. How long of expenses do you have that are actively available versus what you might put into some sort of, treasury, management type account, et cetera. We also hear a lot of people talk about, hacking risk, right? So getting appropriately audited, putting together the right bug bounties, et cetera. How do you structure those things to make sure that you are being as safe as possible? And a lot of that becomes on the protocol side, what is the surface area of attack, right? How complicated is the code? How many different types of protocols, et cetera, do you touch? And trying to mitigate or reduce that amount of surface area. And lastly, regulatory risk is on top of everybody's mind, whether they're, a trader or a protocol, and they're, if they're a protocol, if they're issuing a token, like where should the team be located? How should a foundation versus a corporate entity be set up? How should they structure that token issuance, et cetera? And it's clear today that, within different regions, regulatory risk is higher in certain places like the US than it is in potentially more thoughtful localities like, Asia, or even, the Europe, which I'm sure we'll talk about, Micah, a little bit later. And so we're trying to help people be thoughtful around that as well.
Thanks, Rob. We will definitely talk more about regulatory risk. And Olivier, how you see from a prime broker's point of view, for instance, counterparty risk mitigation, et cetera, how you help your clients?
Yeah, so I think this is an interesting panel because we have several faces of the industry and we each have our perspective. So for example, we're not a market maker and we're not a tech provider. So we'll cater to different types of risks, and customers will typically come to us focusing on credit risk and risk around settlement and clearing. They come to us because they don't want to face exchanges or decentralized exchanges directly. And so we'll mitigate that counterparty risk in different ways depending on the trading profile of the customer. If they're trading OTC with Aplo, well, then they'll leave their assets with either a third-party custodian or Aplo custody, which is a custodian as well. And then we'll settle the trades directly into their custody so that their principal assets are never exposed to the markets. If they're doing some smarter routing, we have a inventory management system that will automatically allocate their assets across different venues to make sure that, it's all not focused on one specific exchange and they don't have to deploy all their assets at once. And we also work with, actually, some of our customers are market makers, and so they'll use us for direct market access. They want to optimize their access to specific exchanges. In that case, they can leave their assets in custody, not on exchange. And then we have third-party financiers who will finance their positions on those exchanges so that in case an exchange defaults, the market maker doesn't take a hit. And so really our job is to offer all those different solutions and make sure that the customer, is able to control and score their risk exposure to different types of venues. We do the same for decentralized exchanges as well, by acting as the main counterpart for those trades.
Thanks so much. Nicola, you alluded to this already a bit. And when we had the prep call, you highlighted that when you onboard a client, you give them a one-pager and you highlight all these 15, 20 types of risks, what they may encounter while working with you guys. So would you like to highlight one or two out of these and give us an example how you help mitigate these risks?
Yeah, and look, I think it's a guide. Like I don't claim that we've thought through every risk that exists in what we think we have, right? We hope we have, but crypto always throws you a curveball, I like to say. So it's in no way meant to be comprehensive, but I think it's meant to be, a good starting point, right? How do you start to think about some of these? And we mentioned settlement risk, right? There is no concept of delivery versus payment. Well, they're starting to be, maybe after some of the events of last year, people are starting to think about, how do I use a third party? I send them my Bitcoin, someone else sends them the cash, and we simultaneously cross. But until those solutions are fully baked, right? I think at this point in time, you do have some settlement risk to your counterparts. And so how do you think about that? Well, one of the ways in which you can think about that is just faster settlement times, right? It's why Rob mentioned banking rails. Is why banking rails are so important, right? As soon as you have fast banking rails, you can you're only as slow as your banking rails at this point in time. So if you have fast banking rails, you can essentially send in cash and get your Bitcoin if your counterparty supports it in a fast time period. And so for us, it's something that we focus on. We strive to have our average settlement time be under 15 minutes. That includes weekends and holidays, really because it does two things. One, it reduces the counterparty's settlement risk, and two, it reduces ours, right? And once you have that velocity of balance sheet, then you're not kind of waiting over the weekend for 3 days and taking 3 days of credit risk to someone for them to settle their positions. And that's really the power of blockchain, right? It's why people want to think about tokenizing assets, because I come from a world of T+1, T+2 settlement. Well, 15 minutes or shorter is where we're supposed to be, but we really need those fast banking rails to do that. And so when we talk to clients and counterparts, we really urge them to get those rails set up, because they are different from the traditional banking rails that exist. Another thing I would say is just, really we talked a lot about, financial crimes or know your client, right? I think we spend a lot of time on that with our counterparts. Right, be aware of what wallets you're sending funds to. Make sure that you verify that they are your counterparts. We have a lot of instances that I can tell you where someone's Telegram got they guessed a password or something and they try to switch out wallets. Well, we have a 24-hour cooldown period for that reason, because we want to avoid someone comes in, gets access to one of our customers' passwords, and tries to switch out their wallet to take their funds, right? Those are all of the things that we want to think through with them and make sure that they have plans in place and checkpoints such that that doesn't happen.
Thanks so much. I love the 15-minute settlement. That's so nice, if that works, really. Oliver, what type of, I think we specifically talked about counterparty risk and how Uplo helps their clients mitigate counterparty risk, and you came up with synthetic exposure. Do you want to tell us a bit more about this?
Yeah, this has been something they came up more and more often since everything that happened with FTX. And so this actually solves two types of issues, and I'll try to simplify it, but you have a range of customers that are not really able to get exposed to cryptocurrency directly for regulatory reasons. They can't get exposed to that regulatory risk or the reputational risk. And then you also have customers that aren't willing to get exposed to the venues on which those assets are traded. And the intersection between those two groups is actually quite large. A lot of them are not able to take either of those two risks. And so they can come to Uplo and require exposure to a specific instrument, could be on a specific venue or spread across a range of venues, but the actual position will be in cash only against Uplo. And so Uplo will both take care of the regulatory risk, because we're the main counterpart in that trade, and we're, again, a qualified broker and qualified custodian, and also take care of the counterparty risk, either using our own balance sheet or using a third-party partner balance sheet that will finance the trades on the venues. But in both cases, the goal is really is for customers who want to get exposed to the market risk of crypto. That's always what they want, without being exposed to the counterparty risk and to the regulatory risk.
Oliver, just a follow-up question from me. Uplo is registered in France, right? In Paris.
Absolutely, yeah.
And you're excited about MiCA coming up. I think
MiCA is a good thing for, I mean, everything that happened recently is a good thing. You see a lot of exchanges moving into France, opening their headquarters in France, getting the license. Also, MiCA is very close, very similar to the French VASP license framework. So the transition might be a bit more straightforward for us. There's just a bunch of reasons for which it's interesting times.
Yeah, I thought, as being based in Switzerland, that a winning Circle to have their European headquarters in Paris. Yeah. So that was a great win for France.
100%.
So the audience is paying attention, but I don't see any question yet. I would love to encourage you all who listen, please interact. Let's make this more insightful. And then my next question goes to Rob. And the question is, when it comes to investing, when you really have your VC hat on and you're in the market to like screening which is the next top 5, top 10 company to invest in crypto? How is Dragonfly Investing focused on risk management?
Yeah, so I mean, there's a lot of risks, and we talked about it. Nicholas touched on a bunch of it, Anton has, and Oliver, that are just inherent within financial services that we're all thinking about it, right? So counterparty risk is something that we've all talked about, in pre-crypto, credit risk, et cetera. But in a lot of cases, these risks are even more pronounced within crypto, in part because of things like 15-minute settlement, like Nicholas was talking about, or finality that happens on chain, very quickly in a way that doesn't happen, in traditional finance. And so, one of the things that we think a lot about is what that risk is supposed to look like, but both from a CeFi perspective and a DeFi perspective, as a venture firm that is investing in both on-chain and off-chain crypto financial services. And so what does that mean? That means that we might need to think about what is the future of risk management for DeFi in a different way than what the future of risk management might need to be for CeFi, right? And we try to predict where the market is going. And our expectation is that all these things are going to come together. There is going to be maybe a kind of staggering of how institutions get into the market, and they may get into the market more quickly in places like CeFi. And so we're spending a lot of times with those businesses and those protocols that bridge that gap, both into CeFi and then future into DeFi. So we can't talk a lot about some of the things that we're investing in yet. Obviously, it's been very topical post FTX, especially on the CeFi side. But we're focused on things that would utilize the benefits of crypto and blockchain networks, but that help mitigate that risk. So, and it might look more like an institution is used to dealing with before. So what does that mean? It means things like using Merkle trees for proof of solvency and for risk management, credit risk management, or things like utilizing potentially zero knowledge proofs for the same type of thing, or even the unbundling of custody, brokerage, clearing, settlement networks that allows for better syndication of risk management, but then also with potentially better self custody or sort of hybrid custody, et cetera. And then there are a lot of novel ways that people are trying to figure out how to hedge risk or reduce credit risk, utilizing both on-chain assets or protocols, as well as off-chain assets. So we spend a lot of time thinking about what are the places where CeFi is the right answer, and also DeFi can be that answer, and then how do you bring the two together? And that's the way we've really kind of started staggering the way that we are investing in those two places.
Before we move on with my questions, I feel like it's a good segue now to take the question asked by Alex Rifkin from the audience. And the question goes as follows. Have you noticed your clients warming up to smart contract risk as an alternative to counterparty risk following the events of 2022? Do you think we may see on-chain collateral management and clearing solutions coming up? Or would institutions, in your view, continue to mostly prefer regulated centralized counterparties backed by large balance sheets? Rob, when it comes to counterparty risk, I feel like you see a lot of startups addressing this through smart contracts.
Yeah, so I can start, and I'm sure the others have a point of view, but listen, there are absolutely people trying to solve that issue today, right? People are trying to do on-chain cross-margining and collateral and settlement that will allow for institutions to enter DeFi. We are, I think, early in the TradFi institutions really engaging with on-chain finance. For the crypto native institutions, there are quite a few people that are sophisticated in figuring out how to engage with on-chain finance. I do believe that there is still a lack of some of the needed tooling that is just inherent with risk management that exists maybe in CeFi that is not in DeFi today. But it is absolutely a place which we see innovation happening, where we expect the market to go. But I do think it's quite early still.
Yeah, I mean, I can chime in a little bit from our standpoint. I completely understand with Robin. That's a great question by Alex. I think we're definitely seeing customers talk about it more and more. I mean, especially in the institutional domain. I mean, what happened with FTX is quite jarring. I mean, effectively, we have quite a few customers that got proper assets locked up on an exchange that they still don't have access to. So there's a couple of anecdotes there. I think the world in general, the way we see it progress, is likely going to be, going to exist in both of those. I think that there's going to be some players that are going to be okay with the scale and with some of the technology that is happening and some of the innovation on chain, and that's going to be a viable solution. But I can tell you, for some of the largest institutions, when we talk to them, they are talking about a centralized facility. They are talking about facilities that are, in some sense similar to the facilities that we have in capital markets that resemble clearinghouses. The hope is to make those more efficient, not to get to the point where you have to have as much capital allocated because of that risk, but rather because of technology, we can actually progress and we can meet in a more capital efficient way. But generally speaking, I think we see both of those happening. There's definitely more interest from a client perspective into any solutions that allows them to more effectively separate the treasury management from the matching facility. And that's been uniform. And I think there's, it's almost without a doubt within the next 2 years, we will even see regulation on that topic. And I'll just share one anecdote. There was a really interesting conversation we're having with one client of ours that said that they are starting to be more friendly. They are effectively saying that they are happier to take some regulatory risk to avoid some of the settlement risk, some of the effectively counterparty risk. And that basically means that they're more favorable into exploring DeFi rails and actually, going through some of the challenges there around KYC ML, not to take the enormous counterparty burden, the counterparty risk burden that they're taking on some of the exchanges. So, I mean, I think we'll see. The last thing I'll just say about this is that I think it's going to be crucial for any solution that arises to make sure that there's also connectivity to liquidity, because you can have as many of those solutions as you want, right? You can always have a tri-party agreement. You will always be able to say something like, hey, let's keep the assets here. But if the client is, if there's not enough participants from a liquidity provider perspective in that domain, and the client that is storing the asset in a solution, some third-party custody is unable to access sufficient liquidity for them to execute the trade, then we haven't done anything, and that's not a solution that's going to work. So it is, to Rob's point, something that still has to progress in the ecosystem, but a very, very important portion of the market structure that's evolving here.
Yeah, and I think that, from a smart contract perspective, right, anybody you talk to, I think would argue that that's probably, the way forward. But I think in order for us to truly embrace that, we have to incubate that first. And let's be clear, what many of the large institutions are really, really familiar with is that, centralized, large balance sheet backed solutions. And if that gets them into the space, I think that that's a huge win for crypto and distributed ledger technology, right? Because a lot of the conversations we have is, well, how do I abstract away some of that complexity because I don't know how to deal with it? And, all of those solutions that we're used to from traditional finance can really help do that, where they don't have to worry about how do they deal with blockchain settlement in-house, because they can essentially farm it out to a custodian or a prime broker. I mean, Oliver, I don't know if you have thoughts on that, but I think that, the goal for us should be getting as much support for the industry and making sure that we're really getting money into the space, rather than saying, oh, well, smart contracts are the way forward, and that's the only thing I'm going to support, right? Like, I think FTX has kind of caused people to pause, and we need to build a little bit of trust back up. And I think the way to do that is by some of these large supported balance sheet solutions.
Yeah, I'll make it very, very brief, but I agree with what Nicola is saying, and more specifically, I think they're not mutually exclusive. I'll just give you a short example. You'll have like a type of institution that will be a large traditional asset manager. They're definitely not going to go on decentralized exchanges today, like 100% not going to go there. They might go through a broker though, or trade with a trading firm like B2C2. And then either that broker or that trading firm will have the expertise and the time to go on the DEX to find the liquidity and trade there. And so essentially you're converting that, technology risk into counterparty risk with either the broker or the trading firm, but both exist at the same time and they just don't serve the same purpose. I don't think we're at the stage where everybody should be connected to decentralized exchange and trade together. Some people might need to go through brokerage and others might actually need to go through the DEX as well, but they could both coexist today.
Thanks so much. Alex, you got four takes on your question. So thanks for engaging the panelists a bit. We have another good question, but I will first prioritize my question I had earlier to Anton, which is the following. How does Talos think about operational risk and how the entire platform is here to support its clients to minimize risk along the entire trade life cycle?
Yeah, I mean, it's a great question. It's so there's a couple of interesting things there. I think generally speaking, when you're building a technology, when you're building a platform for clients, especially when you're doing this in the institutional world, risk and the technology behind the platform, the safety behind the platform is actually about like 70% of it. You can spend about, like probably 6 months to a year rebuilding what Talos has today across, the treasury management solutions, the trading, the clearing settlement, the lending and borrowing tools. There's quite a lot of tools we've built, but you can rebuild that rather quickly. The thing that is harder to rebuild is usually all the safeties that we put in place. So all the functionalities, all the features that people see in the UI or we kind of like advertise, it's very, very hard to advertise what's happening behind the scenes. And in crypto, it became even more important than it was in capital markets. And a quick example of that is when you build things. So we were in one of our previous companies, we were one of the largest providers of trading technology to the sell-side community in FX. You build these kind of systems in FX, UIs APIs are very standardized. They're not exactly the same, but they are standardized. You are cross-connected to everyone. So you have literally private lines connecting you to liquidity providers. And there's quite a lot of other machinery to just make sure that the communication is consistent and effective and safe. A lot of these tools either did not exist or still don't exist in crypto. We have great providers on a network like B2C2, which is really, in the highest tiers of the providers that we have in terms of technology, in terms of availability, in terms of the service they provide, but we have 50 and some different destinations. And as you're connecting your clients over the internet to those destinations, problems arise. And so the kind of risk mitigation that you write into your platform is ultimately what's going to decide whether the client is going to be successful and whether they're going to be safe in terms of operations. And as a reminder, a lot of the trading that we do is in the electronic, in the algorithmic world, right? A runaway algo is something very, very, very possible that happens in capital markets quite a lot. And you write a lot of protection to make sure that that doesn't happen. And so some of those risks, when you're thinking about operational risks, there's a lot of ways to break that down. You can think about the actual technology risks. And for us, the way we help our clients there is, we are the ones that are connecting and we take care of all the communication with the individual liquidity providers. We're basically saying, connect to us once, we'll take care of the rest for you. So you as an organization, institution, don't have to worry anymore about connectivity, any kind of disconnect, any kind of messaging that did not arrive. Some of the risks that we mitigate is what Nicola mentioned earlier, right? We need to make sure that our clients are able to, no matter what happens, they can execute. Some of our clients are some of the largest institutional or retail brokers in the world, right? There is no such world, there's no such thing for them as, all of a sudden I can't trade. And that can happen because you're connected to a single provider, right? So what we do is we connect to multiple providers, our algorithmic environment, make sure that they have the best prices, but also that if a certain provider goes down, we can immediately go and substitute and send the orders to another provider. And honestly, that doesn't end. But as you personally, I mean, a lot of the emphasis that we put is on the safety, is on the redundancy, is on the operability of the platform. Without it, there's really no institutional trading platform. Without it, like anybody can just do it,
Thank you. Yeah, lifting the crypto trading to the same level of sophistication that there is in TradeFire capital markets.
I couldn't have said it better.
Thanks for your take, Anton, here. And I like that the anonymous or dear anonymous attendee has a nice question, which I feel like it ties in well to this part. How detailed is your assessment of custodians. More precisely, what are the elements you look at and the confirmations reports you request to evaluate custodians? Who wishes to take this?
I mean, I'm happy to take it. So we self-custody, but we use custodians because our clients use custodians, right? So oftentimes we need to leave some portion of capital there so that when the trade happens, you know, we can exchange, you know, funds or coins. And, you know, for us, we go really deep. Like we'll talk about tech risk, we'll talk about segregation of assets, right? One of the things we're really concerned about is if a custodian is commingling, right? And so they're doing what I would call like ledger entry segregation of assets. So they're putting multiple assets into one wallet. Well, if that wallet gets some sort of exposure from a sanctioned individual because you happen to be commingled with that, well, then your funds are also, you know, could be tied up depending on the government that's involved, the jurisdictional risk. And so it actually goes, you know, you need to go quite deep into what's happening with our assets when we send them to you. If there is a bankruptcy, right, even at the custodian, what happens? Is it a trust structure, you know, whether that be a UK trust or a New York trust? What does it look like? You know, how often do you social engineer your employees, right? Like, I think you need to understand that business as intimately as you understand your own, because they're going to have your assets, right? And I think that, you know, again, this is where we go back into diversification, right? You probably want to have, it is more costly to have two custodians, but again, something happens to one, you want to make sure that you have the ability to move funds or make margin calls or whatever else ends up happening, because, you know, you don't want to be in a situation where you're saying, oh, but I have funds, but they're stuck here, which just doesn't work in crypto.
I can chime in on this one, even though obviously my answer will be biased because we're a qualified custodian, but there's no perfect solution for everyone. And so we have some basic guidelines we generally recommend to our customers. The first one is make sure that your custodian is supervised in an actual serious regulated jurisdiction. I'm saying that because some jurisdictions have a regulatory framework. That doesn't mean that you want your provider to be there. And so that's the first assessment you have to do. And some areas are known to have stronger regulators than the others. That's the first one. The second one is, well, based on recent events, it might be better if your custodian is not directly exposed to the US regulators, or at least not solely exposed to the US regulators. The reason why I say that is because that's a lack of stability. You don't really know where that what will happen to that provider in the coming 12 or 24 months. And another aspect which is often overlooked until the fund or the company starts actively investing is what can you do with your funds once they're in that with that custodian? Because a custodian, you know, okay, you'll safeguard your funds there, but then you have to trade, and depending on your trading style, you know, you'll realize that you have to withdraw your assets all the time and deposit them on another exchange. And so you can automate that through solutions like Talos, but in some cases it's not even compatible. You know, there's no way to take the assets out or to trade directly from custody. And so just make sure that the custodian offers or partners with other providers that offer additional services that are compatible with your the investment strategy you have. And that's also part of the due diligence, because if you don't do that, then you have a lot more operational risk on your hands.
Yeah, and maybe I'll just jam in a little bit. I'm way more on Nicola's side, because, you know, just like Nicola, we don't have a horse in the race. We follow our clients. We need to make sure that whatever our clients support, we support, and because of that, we have tons of integration with different custodians. But the key thing is, like, you know, we serve that consultant role quite often during the onboarding process. Clients come in and say, like, okay, we figure out trading. Okay, let's talk about the different pieces. Who should we interact with? Who should we trade with? Who should we custody our assets with? How should we settle? Like, how do we actually do this entire thing? So I think Nicola mentioned quite a lot of these things, and that's kind of like the checklist on our side as well. The other things that we look at, we need, you know, before we even do integration, like obviously the obvious thing is that we need the trust of other institutions. We need to know that we have clients there. We have seen interaction with those particular stories, and that's happening even before we have an integration. We look quite a lot at technology. we look at like what's available to us via automated tools. It can't be a high touch system. We need to be able to go, we need to be able to pull balances, we need to be able to reconcile. We need to do this in a proper way. We need to know that the availability is high. There has to be a proper support framework at the custodian. You need to be able to pick up the call and call them. Like whether you want it or not, the institutional wallet is never going to be fully automated. Sometimes you need that touch point. And that's kind of like the thing that we look at. And then finally, you start looking at, okay, what can they actually do for our clients if they meet all those requirements? Obviously, coverage comes to mind. You know, we have quite a few customers, especially on the buy side, that when assets are listed on any destination, whether it's a broker or whether it's an exchange, they start trading those assets hour one. You know, like last year, we traded close to 2,000 different instruments. And so we need to make sure that if there's a custody solution, it meets the requirements of that particular customer, that it can actually provide the coverage that the customer is looking to the universe of the coins that the customer wants to interact with. So yeah, so quite a lot of different ways of looking at providers for the network for us.
Thanks.
Yeah, maybe just a one like small point to add to that too is the way custody works today in crypto is not the way it's going to work in 5 years and 10 years. And if you look at the way they essentially operates today as silos, right? There's not really give ups between, you know, different custodians. They essentially just operate as their own, you know, kind of capital in each different silo. And it's hard to work across or be capital efficient across all the different custodians, which is not a thing that we've ever had to worry about, or we've worried about in any time that I've been alive in the traditional world. And so I think we're still going to see a lot of innovation happening across crypto custody, and both for the crypto natives and as we see some of the traditional guys enter the space.
What I learned in my crypto career that you can't really make estimations or like outlooks more than 6 months ahead. But yeah, it's good to know that you have a 5 years, 10 years view, and we will see how custody shapes out. Super. Now we got to the regulation question, and I think Oliver, you are really, as you expressed earlier, really happy about MiCA. Is MiCA a green light for crypto in Europe? How you as the CEO of a prime broker perceive MiCA?
I mean, it's not the perfect framework, but its value is that for the first time you have the opportunity to address normally fragmented market in a single swipe. You know, you're reuniting all of the EU countries into a single framework, and it actually makes things quite easier for a lot of providers that are looking to set up shop there, or funds that are looking to launch in one of these countries. So that value in itself is very high. The second one is, you know, as a crypto investor, especially on the institutional side, you should definitely prefer jurisdictions where crypto assets are segregated asset class with their own regulatory framework, because this will remove uncertainty around how some tokens might be classified. We've seen this a lot recently in the US. And so MiCA is essentially providing such a framework across the EU with that, you know, simple classification system. And so it kind of eases the burden of making sure, you know, am I allowed to invest in this? Am I allowed to trade this, to hold this? There's a lot less uncertainty around that. MiCA has its issues, and we don't have the time to go around that as you know, but there's a ton we could talk about, especially around DeFi. But it's a good first step.
Super. Then moving on to
Yeah, maybe, sorry, I mean, just
sure.
On the DeFi side, I would just want to make one point, which is that I agree with Oliver that I think, you know, the regulators in Europe are clearly trying to be you know, forward thinking, and they're trying to take somewhat of a common sense approach and, you know, try to be responsive to market norms. But there is a huge question about MiCA and what it looks like in DeFi. And, you know, theoretically, decentralized finance, if it's fully decentralized, without intermediaries, is excluded from MiCA. But, you know, what is fully decentralized? How do you define that? You know, what happens to protocols that often are, you know, kind of centralized up until a point where they start decentralizing in the future to get themselves bootstrapped? That's still a big black box. I think there's going to need to be a lot more refinement around that, and we're going to probably have litigation around it as well. So there's a lot to come, I think, on MiCA.
Thanks so much for adding your thoughts here, Rob. Then the next question, and taking the example of B2C2 and Talos, once a client picks an execution venue, how can we work together here? In this case, an OEMS provider with a liquidity provider, how we minimize execution risk for our customers together. And yeah, how do you see in general working with partners in order to reduce these risks?
Yeah, I think it's a conversation, right? Like different trades require different execution strategies, right? So if it's a small trade and you have your choice of liquidity providers, well, maybe you're just taking, the best price, right? But if it's a large trade or you're on a program, I think then that's really where, the relationship between like Talos and B2C2 comes into play, right? Because and I think I mentioned this before, if you're disseminating a large trade to 15 people, well, one of those people is going to leak that trade to the market, and then everyone's going to know what you're doing. And they might not mean to, right? They might do it just because they're executing the same trade over and over and over again on an exchange, and one of the algos picks that up. And so you want to make sure that the partner that you're partnering with to move that liquidity really has the ability so that there isn't that information leakage. And that's really where Talos comes into play, because they can tell you, okay, well, when you executed on this execution venue, here's what happened, or this liquidity provider, here's what happened. And they can actually almost benchmark. I mean, we talk about in, capital markets tools like TCA, data analysis, slippage, all of those things you can get, by having a full picture, because I can offer it to our client base, but if our client base is also executing with someone else, I'm clearly not sharing that information with some of our other liquidity providers. And, so from a perspective of Talos, they can be really helpful in helping clients kind of shape their execution strategy from that perspective.
Yeah. So I completely agree with that. I mean, that's essentially you're literally asking a question of how Talos is working with B2C2 and players like B2C2, right? It's like Nicola said, every trade is different, and also client requirements are different. We do have customers that are coming in and they need to do an RFQ, or they need to trade a specific size. It's very easy for the clients using the platform basically to say, to Nicola's point, I don't want to show my risk to the entire market. I want to pick these 2 providers, 3 providers, and then the platform will pick the best price for you and execute. That also allows you to meet best obligations that you have, fiduciary responsibilities that you have to your customers if you're trading on behalf of customers, right? So you can actually show, and we provide that capability of showing that you have gotten to the market, you went to the market, you have gotten the best price available, and you've executed on that best price, not because, like B2C2 just treats you the best, but because B2C2 had the best price out there, you have executed the best price. The other scenarios are the more sophisticated ones, and that's exactly where our algo environment comes in, whether it's a VWAP, TWAP, whether it's we have 12 or 13 different algos at this point. Those algos resemble in some parts the algos that we built in capital markets, but crypto is different. The construction of an order book in crypto is different. Tick sizes are a lot more granular here. So there's quite a lot of sophistication that goes into setting up an algorithmic trading environment that can actually meet the institutional bar in crypto, and our clients use that. And then, just to elaborate a little bit more on the benchmarking capability, that's actually exactly what we offer our customers. So from day one, since we launched our algorithmic trading environment, we have a transaction cost analysis, a TCA environment. And we do TCA on an order by order basis. So our clients can take a look at any particular order, even if it was executed immediately or executed over a week worth of time. They can take a look and benchmark that order and see exactly who priced them how and what was their execution relative to the benchmarks of the market. But we also offer this capability on a monthly aggregated basis. The more interesting one is, we're doing things here that we haven't done in capital markets, which is we order the same capability to the dealers. So for instance, B2C2 receives a report from us once a month that is fully anonymized and fully aggregated, and clients are very much aware. B2C2 sees how where they kind of stand in terms of their pricing for the customers with respect to other dealers, an anonymized group of other dealers. And all the dealers on the network receive that kind of report. So we really have the capacity at this point to mitigate the notion of unfair pricing, providing both the clients and the dealers the right tools to actually see, where the price is, what is the best capacity in the market, and so on and so forth. So that's kind of like the interaction between somebody like B2C2, which is providing liquidity to our customers, and us to provide them with the technology to, like make use of that liquidity.
Thanks so much. I think you guys represented very nicely how together as partners you mitigate risk. Then we have 5 more minutes, and I want to be mindful of everyone's time. So Rob, the next question goes to you. You talked about reinventing market structure when we prepped, and can you elaborate a bit more? What do you mean? How institutional market structure has to change in the long run, 5-10 years? Vink.
Yeah, so it's hard to look at that long as we've talked about, and I think everyone on this call will have a point of view, and they may, and I'm sure everyone will have approach it from a slightly different aspect. So I'd love to hear what other people have to say as well. And we've also alluded to it a lot during this call, but essentially, like, institutional infrastructure today is still really evolving and isn't quite at the level that especially the TradFi firms are used to engaging with capital markets, right? And this is, as simple as, what we saw with FTX, which is, hey, listen, the trading stack is fully integrated with custody and clearing and settlement and margining, and we all, and even the CFTC in the US engaged with FTX and LedgerX about a proposal that would have an integrated regulated structure that looked like that. And one of the things that we've seen is people have started to rethink through, like, what is that actually supposed to look like? How are we supposed to syndicate risk? And how are we supposed to think through what are the right pieces to be put together? And this is, CeFi I'm specifically talking about. So there is reasons for things like tri-party agreements, which are, very common in the traditional world, but haven't yet existed as much in crypto, or things like centralized clearinghouses, et cetera. And so we are still, I think, figuring out what that looks like on the CeFi side. And some of this will utilize maybe hybrid on-chain, off-chain finances as well, like we've talked about. Custody, as I mentioned earlier, can be capitally inefficient today. The way people engage, like, bilaterally with exchanges, meaning that they have to post margin to one exchange and post margin to another exchange, that's capitally inefficient. That obviously is something that's going to continue to be worked on to be reduced or changed. I think in on-chain finance or DeFi, as we've talked about, a lot of the tooling, so the portfolio and risk management systems, like Anton talked about, and that they are working on, these are going to continue to have to get better within the DeFi side specifically, and for there to be kind of the barrage of kind of large traditional institutions as we mentioned, and even things like OFAC sanctions, understanding who's within a pool if you're trading through a DeFi exchange, Chainalysis, TRM. There's a lot of innovation happening here, but there is still a lot of concern from the large institutions and how they engage. And I think there's just friction, especially with on-chain finance. So, as Nicola mentioned earlier, abstracting away some of that friction for people and allowing them to have better tooling, and that's what everyone on this call is trying to help mitigate. That will be something that will have to change as we get a much broader set of traditional trading institutions into the space. But would be interested in everyone else's point of view as well.
I can jump in on this one if you want, Emmy. Mine is quite simple and obviously very oriented, but as long as cash and crypto coexist, or at least fiat currencies, and that even within crypto, you've got different blockchain ecosystems, it's going to be very hard to kind of swap one for the other directly. You can't benefit from the instant settlement, atomic swap feature of Ethereum if you're buying ETH with dollars or with euros. And that will probably be the case, at least for the next 3 years, probably for the next 5 years, if we're unlucky, even for the next 10 years, with some degree of intensity. And so in this case, I think what's needed is a clearinghouse, which is what mitigates that risk in traditional finance. Some central entity that can coordinate and net the trades and settle the trades and take that counterparty risk for everyone in the ecosystem, at least every institutional customer or provider, and make sure that those trades actually happen, whether the provider is trading on an exchange or directly OTC with another counterpart, or even possibly against through a decentralized exchange. That's something that might speed up the adoption of institutional players such as banks or very large asset managers, in my opinion.
Yeah, maybe Oh, Emmy, I think you're on mute.
Thank you. I'm just saying that you guys already answered the last question. You mentioned clearing houses, both of you. So the last question is, how do we win? And what is the one thing you wish to see from TradeFi in crypto? How do we get closer to mainstream? If briefly, Anton and Nicola, and Anton, I think you wanted to chime in into the earlier point.
No, I mean, honestly, those kind of like tend to those two tend to blend together. This is how we win. I think it's when we came into crypto like 5 years ago, there were kind of like these two enormous camps, right? The traditional market, there were an army of people in traditional markets that were saying like this is never going to work when they were looking at crypto, and a bunch of people in crypto were saying like traditional markets are going to die. I think that the the answer is obviously going to be the combination of those two. And I think, look, I mean, how do we win? There's simple things that are like a lot simpler than said than done. Education is still playing a massive role. I just had a conversation with a friend that is connected to the regulators here in the United States, and apparently still like a lot of education is needed, and there's quite a lot of people, especially the staffers, that are pushing the envelope there, but still needs to happen, right? Tooling has to come into this, and we're working on this, but also Oliver is working on this, Nicola is working on this. Quite a lot of really good people are working on this and bringing the right kind of institutional tooling that is required. Regulatory clarity in the United States and abroad. By the way, I think it's pronounced MiCA, but MiCA is a good step in the right direction. MAS is also moving the needle forward. Hong Kong is making quite a lot of really, really thoughtful effort into putting the right guidelines. All of those things are correct. I think from a market structure perspective, the things that I'm excited about the most, and why Thales is not only a crypto company, we think about the entire investment life cycle, but we also think about other assets. Generally, for me, I strongly believe that we will see just a flurry of digital assets, and I think we were going to see digital assets covering way more than just crypto itself. I think we were going to see other financial assets. We were going to see real world assets, and the reason is because like I'm an engineer, and I spent my entire career behind the scenes in kind of like the guts of the ecosystem, in the middle and the back office. And what I can tell you is that the minute you start pairing together the movement of funds, the movement of assets with the actual use cases like trading, like lending, that's where you actually get quite a lot of efficiency. So when we're talking about clearinghouse is like a perfect idea of this amazing structure that in capital markets plays an enormous roles. But there's also quite a lot of risk in clearinghouses, and they're enormous. They have to provide a lot of buffer into the ecosystem. With more transparency, real-time transparency into the existence of assets and movement of assets that is happening on chain, you can actually create a much more capital efficient world. You can create a lot more transparency, reduce quite a lot of risk, and the clearinghouses won't have to play the crazy outsized role that they're playing today in the ecosystem. So that's kind of like how I see the environment behave. I think that we're going to see digital assets broaden much more than just crypto. And as a result, I think we're literally going to see an uptick in capital efficiency and lower risk in the entire ecosystem, especially when it comes to trading financial assets.
Yeah, and Emmy, I know we're over, so I'll be really quick. I would say, how do we win? We rebuild trust in the ecosystem, I think is the first thing, and that unlocks more players coming into this space. And then in terms of people always say, what would you like to see from TradFi come into the space? I want to be really careful here because not everything in TradFi is fit for purpose for the space. So I think taking what is fit for purpose and applying it into the crypto and digital space, but then also taking what's really good about digital assets and applying it back to traditional finance. So I think it's a two-way street from that perspective.
Yeah, that's a really good point. Flight to quality and rebuilding trust, clearinghouses. I'm so thankful to each of you. So clap on behalf of the CVA, Nicola, Anton, Rob, and Oliver. Thanks for sharing your insights, and thanks for being part of this virtual session today.
Thanks for having us.
Thank you, Emmy.
Bye for now.
Thanks, Emmy.
Emmy.